Now going to volatility windows, these are only for the cash trading session. So it's based off of the opening range. And volatility windows offer a level for the market to trade within and create a bias for an expansion or set a trap, like what we had today. Half of the time of the opening range is needed to establish a bias. Once a bias is established, the market can only reverse the bias. No other bias can be made. We'll look at that. So for example, a hold, so if the opening range is 10 minutes, then half of that time is needed above the upper volatility window in order to establish a bias. And the reasoning for the time is that you can run into the upper volatility window and even break through that and then come right back down. The question is there enough demand that the market can hold above that resistance level to show that there's underlying demand? And that's where the time comes in. So if it's able to hold for half of the opening range above a volatility window, it establishes a bullish bias, and pullbacks, buyers are lured in on the breakout, and they're also forced to defend pullbacks into the opening range because they want to control the trend of the day. And the last level of defense, once a bullish bias is established, is the reversal window, which is just under the opening range. And again, to reverse that bias, or to reverse the bullish bias, it needs to be a 5-minute hold below the open. So think of it like this: the market opens, breaks through the upper window, the buyers have the upper hand, comes back to the open, the buyers are supposed to defend that. If it loses the open, who's in trouble? It's the buyers, right? So we'll look at a lot of different examples too. And the same thing with the lower volatility window. If it breaks below the lower window, it establishes a bearish bias. Sellers are forced to defend rallies to the open. And in order to trap the sellers, you got to get through the opening range to trap those shorts. So after establishing a bias, the volatility windows becomes first level of support or resistance for the bias to be defended down to the opening range. And the last line of defense is that reversal window to hold the bias for the day. So hold through the reversal window for half of the opening range is needed to reverse the intraday bias. This is what catches the session on the wrong side, kind of what creates traps, and it gives way to expand that in the opposite direction. So a bias can be established sometimes just to lure in traders to set a trap and turn it right down. So a failure to see continuation sets those traps, and that's, we did have that today, and I'll show you. You can see the screen share. This is today's action really quickly. You can see the market gets through the upper volatility window, establishes a bullish bias, comes down into the open where you get this big fight. The buyers try to defend the open. Once the reversal window was lost, the buyers from the session are caught on the hook, and it gives way for a little bit of a liquidation down. But